Hi, my name's Dave, and for the last 30 years I've invested in the stock market in stocks and shares. I've made a few mistakes, but I've also had some quite good success, with some shares going up to nearly 400% from what I originally paid for them. But if I'd known what I know now on some of the ways in analysing the shares, I could have certainly made more profits. So the video you're going to see shows you some of the tips which I've put together, which I hope you'll find useful. So what I've done is put together some tips which have worked well for me, and I hope they could prove successful for you. How are you investing your money at the moment? Well, I guess like a lot of people, you're probably putting it in a building society. And sadly, the typical return you get on a building society is around about 1%. Now, banks, sometimes they can be better, but most of the banking statements I've seen come through and the leaflets coming through from banks is you're lucky they give you 0.4%. Some it's even less than that. It almost goes into extra decimal points of a percent, and it's hardly anything. They're just looking after it for you for virtually no return. Now, you can get higher returns by committing your money to what's called fixed bonds, and that means where you invest in for a set time, a set number of years, and you get a higher return, and it's fixed, so that if for some reason interest rates suddenly shoot up, you don't gain from that. You just stick at the same rate at which you've committed to. Similarly, that can work the other way if interest rates plummet, but they really can't plummet much more than they are now. So the disadvantages really are very much low interest. And to get better returns, you've got to commit your money to longer investment periods. But the advantages are that you are protected through the Financial Services Association. And that means if a building society or a bank runs into financial difficulties, you will get your money back up to around about £80,000 per person. So technically, you won't lose your cash, and it's a safe form of investment, but returns are pretty low. So we're going to talk about shares, and you might say, well, I don't really know what a share is. Well, a share is a proportion of an asset or value of a business, so it's not the whole business, but it's part of it. And what you may say is, well, I've seen shares, they're all priced at all different levels. I've seen some at pence, and some that as high as £50 a share. So what should I be buying? Should I be buying the shares that look cheap, or should I be buying the dear ones? Well, the truth of the matter is it doesn't really matter, because say for example, if a company is valued at £4,000, now I know a company will be valued a lot more than that, but in practice it keeps it simple. You could have 100 shares which are effectively £40 each. That makes your total value of £4,000. Or you could have 10,000 shares at 40p each. So it doesn't really make any difference. You just need to buy more shares if they're actually cheaper. So the value of the company still really stays the same. Now also you may say, I've heard about dividends. What does a dividend mean? Well, not all companies pay out dividends, but some companies give you a dividend depending on how well they've been achieving in their financial results. Now these dividends can be quite high. They can stretch up as high as 6%, or they can be quite low and not even pay at all. Now the other question you may be asking is, can I lose my investment or part of it? Well, sadly you can, and this is really why you have to be very careful in the way in which you do invest your money, or decide at the right time perhaps to pull out of a particular company, so you don't lose all of what you put in it. You can lose all your money if a company goes into liquidation. Yes, sadly you can lose all the money, but you really the skill of it is to try and pick some companies that are fairly stable, and that won't happen. So why are stocks and shares better than perhaps putting it in a building society? Well, obviously shares can gain or lose in value. I mentioned before that I've had some shares which have gone up 400% from what I paid for them. Excellent shares and given a good return. On the other hand, there have been some shares which I bought which you can lose on. So you have to be very careful that you don't commit all your shares into one company, or you try and spread it across different types of industries so that you've got a balanced portfolio. And even if a share does not gain in value, some companies, as I mentioned earlier on, pay good dividends of up to 6%. So if the value doesn't go up much, it doesn't really matter, because you're still getting a return of 6%, which is far more than probably what you would have got if you'd put it in a building society. Now, you don't have to tie your money up for long periods with stocks and shares. You can sell them whenever you wish. You can buy them tomorrow morning, and if you didn't like them, you could sell them a day later, or even a few hours later, if you changed your mind or circumstances changed. So the key question is, how do I know when to buy or sell a share? Well, the basic principle buying shares is obviously to buy at a low price and then you sell at a higher price. So the difference when you buy and sell times the number of shares you have means that's the amount of profit you're going to make. But how do you know when the right time to buy is, and when do those positions really occur? Now, as a starting point, if you're new to this, I would pick companies that are what I call fairly well established, and they're what we call blue chip companies. They're companies probably that are listed under the FTSE 100 index, or some of them maybe in the 250 index, and companies that have been trading for a fairly long time, and they're fairly established, that they're probably unlikely to go really badly, because they are they have got a good financial background. Doesn't always follow, but these things can change, but that's the better, safer approach, to go for those sort of companies. What you need to do is first just study their performance and look at their future business plans and see if you agree with the sort of strategy that they're coming up with. So familiarise yourself with the type of companies they are. And if you know a bit about certain industries, that's even better, because you've got some knowledge perhaps that other people haven't got, and you know when you get the right signs that they are doing better perhaps than you think or think they are. In order for you to be able to buy and sell shares, you need to sign up for a share dealing account. Now, this is an online account which enables you to trade from the comfort of your own home onto the stock market. Now, there are various companies to choose from that manage these accounts, and the best thing to do is to do some online search to see which account is the best one for you. Now, usually you can set up these trading accounts in a matter of minutes, and typically each trade would cost you around about £10 plus a government tax of 0.5% on all the purchases. And then when you sell the shares, you obviously pay another trading fee, which would be the same as the purchase fee of £10 when you sell them. So these fees do vary depending on which account you go for. Some offer you a set management fee and then free trades. So the best thing is to look into it and see which one you find suits you the best. Now, the other advantage of these sites are that you can manage and monitor your whole of your portfolio on one site. So you can see what your total worth is, you can see how the shares have changed each day, you can access the graphs of the performance of each company's, and do a lot of research before you get to the point where you actually start to buy the shares. What I'm just going to share with you is a system which I've used and I've found fairly successful. Now, you look at the share graphs of each of the companies that you perhaps are interested in, and what I use as an indicator is the RSI indicators. Now, when you set your share price graph up, and I'll show you these in a minute, you also set it up to show you what the RSI of the 14-day and 25 and 21-day results are. Now, already you're probably saying, what does an RSI stand for? Well, it means relative strength index. i.e. it's comparing the share price with other shares in the same sector. So it would look at other companies that are doing the same sorts of things. So if it was a supermarket, it would be looking at Tesco's, Sainsbury's, possibly Marks and Spencer's, and all those particular companies that are in that sector. And it would be comparing the strength of the share that you're interested in with those companies. Now, what I'm now going to show you is an example of 3 blue chip companies and how you'd analyse the graphs to find out what I think are the key points of when you should be buying and selling these shares. Now, first of all, we've got BT, British Telecom, is a good company to look at. They're a fairly large company, and they are what we call a blue chip company. So this along the top here is the graph showing the share price. The prices are down the left hand side here, and I've analysed all these just over the last 1 year period. So you can see how the share actually started to diminish away with British Telecom. This line through here, which comes up on the screen when you go onto their when you look into the share performance chart, is the times it's been the trading amount of trading that's happened, and in the red it's selling. Well, the red is the falling price rather, and the blue is sector is when the price is rising. These are the two RSA lines which I'm particularly interested in. That's the 14-day one and the 21-day one. Now, the areas that you need to look at are this. I've coloured pink along the top there. This is the top section where the RSI indicator is, if let's take the centre line is 50%, the RSI indicator here would be in the sort of 75% region. And similarly, on the bottom section there, you're looking at where the RSI goes around under the 25% barrier. And that's the 14-day one, and that's the 21-day one. Now, what we're looking at is where, for example, a sale will be when the shares have gone up really high and you think it's time to take some profits. And how do you know when that is the best time? Well, one of the key indicators I found is when you analyse these two graphs, and if you can line up where they both go into this pink zone, that would indicate a sell area. Now, what I've done is illustrated that on these lines here. So if you take this red line going up through here, that's gone over the 75% line there, and it's gone over the 75% line there. Projecting that up through hits that peak up there. So you don't have to even know what this is doing. This remotely is telling you that's the point perhaps you should be selling. So on this particular case, it's when BT was 3.95 pence per share. Coming further along here, it happened again down there, and that's the share price is obviously lower at this point, but it's still indicating that would be a good time to sell. And similarly at this point down here, where those two have occurred, there's a sell point there. So during that whole year, there were 3 key points when it was worth selling those shares. Now, putting on the buy lines, and the similar sort of rule applies here. So if you're under the 25% consistently on both sets of lines, there's a point that's occurred there, so that would represent a buy. And similarly over here, where that's occurred there, there's a buy there. And similarly, almost to present day, they're coming down to the point where there's a buy again. So if we analyse what the profit would be had we bought shares during these trigger points. So if we'd have bought here and we sold there would be a profit of 17 pence. If we'd have bought here and sold there'd be a profit of 25 pence. If you were trading in, say, 1,000 shares, now 1,000 shares in BT, you're looking around about, obviously, 1,000 times £3, it's about £3,000, just over £3,000. During that period, you could have made £420. Obviously, you've got to deduct your dealing charges, but that's quite a healthy profit from dealing with just buying and selling the shares at those key points. Also, with BT, they do pay quite a good dividend, so you might also want to look at the key times when you need to hold those shares in order to get a dividend, and that's another matter. You may decide not to sell the shares because you actually like the dividend that's coming through and it's worth holding on to it. But there's an example how you can, even though that share overall has started to sort of have a downward trend, it's still possible to make money although the share is going down. Now let's just look at another company. Here's National Grid. They're obviously in the electricity sector, very stable company, good assets, and again, this is the graph of the National Grid. It's a share which is currently around about £11 each, and again plotted the RSI 14 and 21 day lines on here. This section here shows when red's where the price is falling and the volumes occurring, and also the blue is when the prices rise, and that sometimes can give you an indication of what trading is doing, but that's probably the subject of a future video where you can really get the benefits out of that. So adding on the same criteria as I did before, we highlight the two zones we're looking at, which is the pink zone, which is the sort of sell area, and the blue zone, which is the buy area. And putting the lines on here, we have one occurs through here where it's a sell. It's important to make sure that they line up. You'll get somewhere back here where one goes through but the bottom one doesn't go through, so that's not really a sign that you're looking for. So there's a sell one, and then we have some buy ones that occur on here. So this is a slightly different sort of arrangement. But if you went back to here, where that's both definitely showing in the 25 zone there, use a buy there, and that would be buy at £10.20 a share, and here's a sell there when it's gone up to £11.25. Now as it's coming down, you're seeing a situation which says buy, and you're not really getting to a point where you're seeing a sell. So you've got a buy and a buy. So if you're faced with that situation, you've got to decide whether you are going to perhaps buy some more shares or whether you're going to hold on and see how things go. Now, the advantage of a blue chip company is that though they may take a bit of bashing on their shares, by and large, over a period of time, they do start to move up again unless something is seriously gone wrong. But nevertheless, had you bought the shares here and sold them there, you would have had, and if you bought 1,000 shares, that's an investment of around £10,000 or £11,000, you still could clean up £1,050 in profit, less of course your dealing charges, which, you know, for that size investment is a 10% return plus any dividends that they may be paying if you had the shares held at the right time. And the last one I'm looking at is another company which has had some steady growth to it, which is Berkeley Homes, or Berkeley Group, which they build quite upmarket houses and do a lot of conversions to property in the city area, which, you know, they're high-priced houses and accommodation, which could be vulnerable, but nevertheless is done quite well. So as I've explained the techniques before and that, I've gone straight to showing you the graphs of how this one would work. And here you have a buy situation here and a sell there, another sell there, where you might not have any shares to sell there, but suppose you bought here again and there and sold there, and again you've got a buy situation here and a sell situation there. Totaling all that up, that would result in, if you had 100 shares, because these are quite expensive shares, they're they started off around about £24 and they're now nearly £40 a share. So you might not be able to afford to buy 1,000 shares of those, but you might go for 100 shares of those, which would be an investment around about £3,000. And here you are, there's a potential profit that could have been made of £1,500, again less the dealing charges. And again, Berkeley Group pay quite a good dividend, so you may actually say, well, I don't want to sell them, I'll keep them because I like the dividend they're having and they're generally growing. I mean, you can make money by just buying them there and selling them up there. You don't always, but this, by using this method, by coming in and going out, you are effectively protecting your assets because you are not necessarily staying long term in a particular company. So I hope you found that interesting. There's a few points just to remember. This method is better than just guessing, and it may not always work. Sometimes it doesn't work, but it's better than just buying a share and thinking you can keep it for 20 years and it will automatically make you a profit. It gives you some sort of substance to the way in which you're looking at shares. Also, it's worth just testing the method for several companies to see if there's a trend. And you can try that on several ones, because some companies lend themselves well to this technique and others don't. So you think, well, I don't know, it's not working for this company, so don't use it. But the more you get to know about how they operate the shares, you can see a trend if it's coming through. If the company pays a good dividend, I've mentioned before, it's worth checking the dates to see what dates you're supposed to have to hold those shares to get a payout. It may pay you to keep those shares for a bit longer. And basically, a golden rule is really never invest what you can't afford to lose. Now, obviously, with shares, and I've said before, they can go up, they can make you some handsome gains, but they can go down. So it's not always a good thing to put all your money into shares. You need to keep a balanced portfolio, and that's really an important point to remember. Okay, well, I hope you found this video interesting. If you're first time to the stock market, some of the things you've seen may find a bit confusing, but play it again and check it through and see if you can understand it in more detail and try out some of the things I've suggested. If you've liked this video, don't forget to press like on your computer, and at least I can see how well this has been appreciated. Thank you very much, and good investing and good luck.